A good index fund can outperform a bad rental property, but give me £50,000, I could either own a £50,000 of shares or control a £200,000 property. But before you rush out and buy a house, there is a dangerous side of that maths that most property gurus and property investors conveniently leave out. And in this video, I'll show you both sides. I am Rahim. I arrived in the UK at 15 years old. I could not speak English, no connections, I had no money, and I had no idea how to build wealth. Years later, I became an accountant, working hard but still living paycheck to paycheck. That's when I decided to take control of my financial future. I started investing in property with no experience, no money, no connection, and building my way up to multi-million pound property investment portfolio. Along the way, I've been featured on the BBC, Business Insider, magazines, and national newspaper, and I've helped more than 2,000 professionals start and grow their own property investment portfolio. Many of them have gone to become full-time property investors, and some have even become property millionaires. Welcome to the blueprint of success. If you're serious about building wealth through property investment, achieving financial freedom, developing the right mindset, and becoming the best version of yourself through personal development, then you are in the right place right now. Hit that subscribe button and let's build your blueprint to success together. Listen, in today's video, I'll walk you through the differences between investing in shares versus investing in property and the advantages and disadvantages of each, and why I choose investment property over stock and shares. Listen, if you can invest 10 minutes to learn the differences between shares and property, the advantages and disadvantages, so you can make a wise financial decision, I'm afraid you're not going to make it. For the few of you who stick around, let's get started. Look, most busy UK professionals are asking the same questions. Should I invest in stock and shares, or should I use my savings to buy an investment property? They are earning reasonable money, but they are still exchanging their time for a salary. Their savings are growing slowly, their bills are rising, and their financial freedom still feels years away. They want profit, cash flow, passive income, capital appreciation, but they don't want to make a £50,000 mistake. So let's compare both investment honestly, not with hype, with real maths. Look, I had a professional career, a regular income, a respectable job, but I was working 6 days a week and trading most of my time for money. And at one stage, I was living in a 9-bedroom shared house with my wife and baby. That period taught me the differences between income and freedom. A salary can make you comfortable, but when your salary stops, the income normally stops with it. I thought I needed assets, something that could earn money without needing another hour of my life every time. That led me into property investment. Look, it wasn't always easy. I had rejected offers, finance challenges, difficult tenants, builders who caused delays, refurbishment costs that increase halfway through project. I've bought the property that looked like opportunity but came with serious problem to solve. But property gave me something important: control. I could negotiate the price, improve the condition, change the layout of the property, increase the rent, refinance where appropriate, and use the cash flow or released capital to buy an other investment property. Here's an example. One of my projects involved buying a derelict house for approximately £99,000. I converted it into 5 self-contained apartments. The journey involved delays, problems with builders, defects that had to be corrected. But once completed, it was valued at £311,000. We did not simply wait for the market to increase its value, we created the value. That experience shaped how I compare investment properties with stock and shares. So let me put them head to head. 1. Leverage. You see, when it comes to property, most powerful advantage is leverage, but it is also the most dangerous. Imagine you have £50,000. If you invest that £50,000 in shares and your investment rises 5%, you have made about £2,500 on your investment. This is before tax and transaction. Your growth is calculated on the £50,000 you've invested. Now imagine you use the same £50,000 as a 25% deposit on a £200,000 investment property. For simplicity, let's ignore the additional buying cost. If that £200,000 property rises by 5%, the gross increase in value is £10,000. That £10,000 increase is equal to 20% of your original £5,000 deposit. The property increased by only 5%. But because you control a large asset using finance, the potential return on your cash was magnified. That is leverage. Your deposit is the small key controlling a much bigger door. But here's the bit some property educators or guru leaves out. If the property falls by 5%, you haven't lost £2,500. You've lost £10,000 in value. That is 20% of your £50,000 deposit before accounting for buying and selling costs. And you still owe the mortgage. Leverage doesn't know whether you are winning or losing. It simply magnifies the result. Here's the common mistake amateur investors do. They borrow as much as lenders will give them, assuming property price will go up. They build a tall portfolio on a shallow foundation. Here's how to overcome it. Stress test the deal. What happens if interest rates rises? What happens if the property is empty for 3 months? What happens if you need a £5,000 repair? What happens if the valuation comes lower than expected? Keep an emergency reserve. 2. Cash flow. Massive difference. Shares can generate income through dividend, and this if the company pays dividend. And if they are, we're talking pennies. You can also sell a small part of your investment if you need money, but dividend is not guaranteed. A company can reduce or cancel dividend payment as well. Here is one of the massive difference. Property can generate monthly rental income. For example, imagine property rent for £1,200 per month. That is £14,400 in gross rental income. But gross is not profit. You still need to deduct the mortgage, insurance, maintenance, management, compliance, service charges where applicable, empty periods, license and tax. After all those expenses, perhaps that property leaves you £500 per month realistically after all operating expenses as profit. That would be £6,000 in annual net profit before any tax. Look, my personal property rule is that I generally want at least £400 net profit every single month because cash flow is the oxygen of your property portfolio. Capital appreciation might make you wealthy in the future. Cash flow helps you survive today. The contrast, shares can be like planting a tree and allowing it to grow quietly. A good rental property can be more like planting a tree that also produces fruit every month. But that fruit needs to be looked after. Tenants need managing, repairs need handling. Rent doesn't magically become passive income on completion day. 3. Capital appreciation and value creation. Both shares and property can increase in value. With shares, your return depends on how the underlying businesses perform and how the market values them. As an ordinary shareholder, you have a very little direct control. You cannot phone the chief executive and tell them to improve the company. You see, property is different. You cannot control the entire property market, but you can influence the value and income of your investment property. You can add a bedroom, convert a loft, improve the kitchen, add another bathroom, reconfigure an inefficient layout, improve energy efficiency, convert a large property into HMO, but also convert a suitable commercial building into residential accommodation. That is forced appreciation. You are not only waiting for the tide to lift your boat, you are improving the boat yourself. Here's an example. Imagine buying a tired investment property for £140,000. You spend £25,000 refurnishing the house. After the works, the property is valued at £210,000. You have potentially created value by solving a problem, but only if the final valuation and the rental income justify the total spent. Here's a mistake most amateur investors do. Some investors treat refurbishment like an episode of a television makeover program. They overspend. They install expensive fittings they personally like. Then discover the local valuation and rental ceiling hasn't moved. If you're serious about investing, here is how you can overcome it. Refurbish for the tenant and the local market, not your ego. Every pound spent should do at least one of the four things: protect the building, increase the value, increase the rent, or increase the future maintenance, or reduce the future maintenance. If it doesn't none of those, ask why are you spending it. Now, stop for a moment, because you might be thinking I'm about to say property wins every category. It doesn't. In fact, shares completely embarrass property in the next 2 rounds. Sorry for interrupting this video. I just wanted to draw your attention to a guide I've just created. This guide is for you if you're looking to start and scale in property investment, and you've got questions that you want to ask in order to start your property investment. This guide is the ultimate guide to start and scale in property investment journey. I talk about the different type of investment strategies. I also discuss the 11 ways you can raise finance to make any property no money down deals, and the type of properties to buy in order to generate a serious return in your investment. And I'm giving this book away for completely free of charge, no string attached, nothing, absolutely free. Click the link on the description of this video to get your free guide now. We've only got a limited number of these copies available as well, so click the link to get your guide now. Let's get back to our video. 4. Liquidity. You see, shares wins this round comfortably. In many cases, you can sell an investment in minutes during market opening hours. You can sell £1,000, £5,000, or the entire holding. You cannot sell the bathroom from your rental property because you suddenly need £10,000. You see, selling a house can take months. The buyer can pull out. The survey can uncover problems. The mortgage can be declined. A property sale is a chain of people who can all change their minds. Shares offer flexibility. Property locks your capital inside bricks and mortar. That can sometimes be useful because it stops emotional sellings, but if you need money urgently, bricks are difficult to spend. 5. Simplicity and diversification. Shares also win on simplicity. A broad investment fund can give you exposure to many businesses, industries and countries through one purchase. You can begin with a relatively small amount. You don't need a solicitor. You don't need a builder. There's no tenant calling about broken boiler. But also there is no gas certificate, electric report, or leaking roof. Property is usually concentrated. One £200,000 property is still one property, one location, one tenant group, one local economy. A major repair or long vacancy can damage your entire annual return. Some property investors own 3 houses on the same street and call that diversification. It isn't. That is one local risk repeated 3 times. Serious investors, as their portfolio grows, they diversify carefully across towns and cities. They get good management agents, good maintenance team, locations, tenant types, property strategies, lenders, and eventually other asset classes within the same property market. 6. Control. This is where property comes back strongly. With shares, you are mostly a passenger. With property, you can take the steering wheel. You can negotiate below market value, choose the tenant profile, improve the property, change the management agent, reduce unnecessary cost, refinance when appropriate, and also alter the use of the property. As an entrepreneur, this matters to me. I prefer investment where my knowledge, relationship, and problem-solving skills can influence the result. Most people look at a rundown property and sees stress. An investor sees a problem with a price attached. And guess what? Investors get paid for solving problems. Let's now look at the £50,000 head-to-head test. Investor A places £50,000 in a diversified investment portfolio. The advantages are easy diversification, high liquidity, very little day-to-day management, potential capital growth, potential dividend income, and access to tax-efficient investment wrappers, subject to the rules. However, the disadvantages are no direct control over the underlying businesses, market volatilities, no ordinary mortgage leverage, and the temptation to panic and sell when the market falls. Investor B, invest in property. He uses the £50,000 towards a deposit cost to buy £200,000 investment property. The advantages are control of larger asset through leverage, potential rental cash flow, potential capital appreciation, the ability to add value, and greater control over the outcome, i.e. they determine their future. Yes, it comes with disadvantages too. Mortgage risk, high entry and exit costs, maintenance, regulations, tenant problem, low liquidity, and more time and responsibility, especially if they're inexperienced investors. So, which investor wins? It depends on the deal. The purchase price, the mortgage, the rents, the cost, the location, the investment fund selected, the holding period, and the behavior of the investor who's making the decision. Look, there's no honest answer that says one always wins. Listen, the real comparison is not property versus shares. It is a good investment versus bad investment. Why I still choose property first? Here is why I still choose property. Despite all that, I still lean towards property, especially for someone whose goal is to build cash flow and financial freedom. If I was starting again, I wouldn't treat this as property against shares forever. I will use my active income to build the deposit and reserve. I will buy carefully selected cash producing properties. I will reinvest the income. I will grow the portfolio without becoming dangerously over leveraged. Once I have few properties under my belt, I will use some of the wealth and income created to diversify into stock and shares. Property would be my wealth building engine. Shares will become part of my long-term diversification. Let me ask you a question. Would you rather own £50,000 of an investment you could sell with a few clicks, or use £50,000 to control a £200,000 assets that could pay you monthly? Look, for me, property wins as the first wealth building vehicle. Not because it is passive, not because it is guaranteed, and certainly not because every property goes up in value. It wins because I combine money, knowledge, and action to create results and make my money work a lot harder for me. Which investment strategy resonate with you? If you like this video or any of my videos, hit the like button below, subscribe for more honest conversation about UK property investing, cash flow, passive income, capital appreciation, financial freedom, money, and long-term wealth creation. I look forward to sharing the next one.